Particularly in few years, cryptocurrency has swept the globe. These digital currencies now have a combined value of roughly $2 trillion. The most well-known of these is Bitcoin, which is alone worth more than $800 billion. In this digital gold rush, investors have descended in droves, frequently with little information but much optimism. Many investors are debating the role of equities in their portfolios in light of cryptocurrency's quick rise. But stocks and cryptocurrencies differ in several ways. The most significant differences is that a stock is an ownership stake in a corporation that is supported by its assets and cash flow, whereas cryptocurrency is typically unbacked by anything. When purchasing cryptocurrencies, it's critical to comprehend what you're getting and how it compares to more established investments like equities, which have a proven track record over time. Welcome to Good Lucks, a channel dedicated to inspiring you to expand your mindset, make general life breakthroughs, and realize your full potential to see what life has to offer. Any shrewd investor needs to be completely aware of their investment. It's critical to consider the investment's risks, benefits, and factors that will determine its success. They cannot do the calculation if they lack the necessary information. In this instance, it's more akin to gambling than investing. In this video, we examine the important stock market and cryptocurrency information that investors should be aware of. Let's get started. What are stocks? A share of ownership in a company is known as a stock. If you become distracted by the fluctuating stock prices and the opportunity for profit, it's simple to lose sight of this. The stock allows stockholders a claim on the company's assets and cash flow because it represents a legal ownership stake in the company. These support your investment and serve as the foundation for its estimation. Why stock prices fluctuate? The value of stock changes as investors predict the company's future performance. The stock price ultimately depends on the company's capacity to increase earnings over the long term, notwithstanding the possibility that investors may become too excited about the stock in the near term. In other words, a stock increases over time as a result of the underlying company's growth. What is cryptocurrency? The most widely used crypto coins, like Bitcoin and Ethereum, are not often backed by any tangible assets, with stable coins being the obvious exception. Using a cryptocurrency may enable you to carry out specified tasks, such as transmitting money to someone else or executing smart contracts when certain criteria are met. Why cryptocurrencies fluctuate in value? Cryptocurrency prices are only affected by speculation, fueled by mood, because it is not backed by assets or cash flow. Prices alter, often significantly, when the mood changes. Therefore, the only motivation for using cryptocurrencies is the belief that they will increase in value in the future. This is known as the greater fool theory of investment. You need to sell it to someone else for more money than you spent on it. Investing in cryptocurrencies versus stocks, pros and cons. Advantages of cryptocurrency investment. Possible protection against fiat money. One of the cryptocurrency's main draws for some investors is that it is decentralized. It is not governed by governments or central banks, which frequently issue money and cause inflation in fiat currencies, like the US dollar or the euro. Some investors who hoard cryptocurrency because they believe it would shield them from inflation have dubbed it digital gold. Possibility of substantial gains. Investing in cryptocurrencies has the potential to yield significant returns. Since they were originally released, the prices of many cryptocurrencies have skyrocketed. The primary draw of cryptocurrencies is these profits, but the possibility of price growth carries a substantial amount of risk. Increasing coinage. There were just a few coins that could be purchased in the early days of cryptocurrency, but this has changed as a result of speculative interest. There are now thousands of coins to pick from, and new coins are frequently being released. The use of digital currency is very popular. Investors, businesses, and governments appear to be showing an increasing amount of interest in cryptocurrencies Before changing its mind, Tesla briefly accepted Bitcoin as payment and lists it as a holding on its balance sheet. El Salvador chose to accept Bitcoin as legal cash in 2021, but the IMF has asked the nation to change its mind. For investors, the growing acceptance of digital currencies could be advantageous. Cons of cryptocurrency investment: extreme turbulence. Since their relatively recent inception, cryptocurrencies have been incredibly volatile. Since they aren't supported by anything, traders' whims decide the price at which they trade. It doesn't take long for fortunes to be created and destroyed, and you never know where a coin may trade next. Threats to cybersecurity. Despite Bitcoin proponents praising the security advantages of virtual currency, there have been major cryptocurrency attacks. Recovering stolen money is frequently challenging. No inherent worth. Since cryptocurrencies lack an intrinsic worth, they aren't supported by underlying assets or earnings the way equities are, as opposed to stocks. Unlike cryptocurrencies, which provide nothing of the type, stocks are valuable because of their potential for future earnings and what they will mean for their owners. Legal dangers. While El Salvador has accepted Bitcoin, many other governments are significantly more dubious. They are entirely prohibited in China, and other nations might follow. Benefits of stock investing. A long record of reliable returns. Stocks have a lengthy history of generating reliable investment returns over the long run. The S&P 500 returned roughly 10%, even though stocks have historically been safe to hold for extended periods of time. They can be volatile in the near term. They possess inherent worth. A stock is a stake in a business, and the performance of the underlying business determines how much it will grow to be worth over time. Companies possess resources that generate income and cash flow for investors, so establishing what is referred to as intrinsic value. Accessible. Nowadays, investing in stocks is simpler than ever thanks to the elimination of trading costs by several online brokers. You have the option of investing in individual equities or selecting an index fund to buy a balanced portfolio of stocks. Even if you don't have much money to start with, you may still develop a diverse portfolio with the aid of index funds, which help keep costs low. Enhanced regulation. The Securities and Exchange Commission is the channel via which companies are required to communicate specific information to investors. Stocks have been around for a while, and there are certain investor protections in place, but no regulatory agency is flawless. Cons of stock investment. Volatile. Stocks are less erratic than cryptocurrencies when you invest in index funds that carry a diverse selection of stocks. Individual stocks can be more volatile than cryptocurrencies, but usually not as much. Due to this volatility, it is advisable to hold stocks as a part of a long-term investment strategy, so that you have time to recover from any temporary losses. Less chance for extreme gains. There is probably less possibility for the kind of spectacular increases that occasionally occur in cryptocurrencies, in broad stock indices like the S&P 500. Over the long term, stocks have returned roughly 10%, whereas cryptocurrencies frequently fluctuate by 10% in a single day. Which should you invest in? Stocks or cryptocurrencies? Which should you invest in? If you have the extra cash, investing in both may be the wisest course of action. The majority of your portfolio should be allocated to steady, lower risk investments like S&P 500 index funds, mutual funds, and exchange-traded funds, according to several financial experts. You could decide to invest a tiny portion of your money in high-risk, high-reward investments like cryptocurrencies. You ultimately decide how much of your assets are speculative, but experts advise keeping it to 5% or less. The only money that you won't need soon should be put in these investments. The advantage of using Bitcoin in your portfolio diversification is that if the value of cryptocurrencies soars, the 5% you invest in them will enjoy great returns and might significantly boost the value of your portfolio as a whole. At that point, you might sell some and put the proceeds back into your safe investments, never keeping more than 5% of your portfolio invested in risky securities. Over time, interest in both equities, stocks, and cryptocurrencies have increased. When it comes to these two investment possibilities, there are some distinctions. To begin with, the danger level varies. Huge risk offers the potential for high returns. You can decide whether to invest in stocks or cryptocurrencies based on your level of risk tolerance. Additionally, you have the option to diversify your portfolio by combining the two into ratios that best suit your preferences and investing goals. Post any more queries or remarks in the comments area. Click the like and subscribe buttons if you enjoyed the video so that others might view it and be inspired. To ensure that you don't miss any new videos regarding personal development, enable the notification bell as well. We'll see you in our future videos.